Hey folks, welcome to another product review at Finominal. Today we're going to look at Cambria Investments Tail Risk ETF, which has the ticker TAIL. It manages around 170 million bucks, and that used to be a little bit higher, and that kind of like outlines the nature of tail risk strategies in a sense that investors are most interested in them after the event has happened, which is usually a stock market crash. And once markets recover, investors lose interest, and kind of like AUM goes down. So let's kick off with a quick review of its performance on the securities analyzer. And a tail risk strategy does not have a benchmark, so we simply compare it to the market, i.e. the S&P 500, and see if it does what it's supposed to do. And yes, we can see that. We can see the market since 2018 kind of trending upwards, and you can see that the tail ETF effectively has been doing the inverse. So it did increase when the market fell, right, in 2019, during COVID 2020, right? But aside from that, it's basically consistently losing strategy. This kind of profile is usually called the bleed, because you're kind of bleeding out on a continuous basis. Now, let's look what's driving this portfolio or this ETF, and we're going to do a quick factor exposure analysis on our two portfolio factors, where we will focus on the asset class exposures, because that will give us an indication of what's making this product tick. So here you can see the asset class exposures of factor betas. You can see TAIL has a highly positive exposure to bonds and a highly negative exposure to equities, the S&P 500. And that simply highlights how the portfolio is constructed, which is very straightforward. It holds US Treasuries. It uses the income from US Treasuries to buy put options on the S&P 500. So I love, in terms of transparent, simple products, because it kind of like means that you know what you're getting, and you see that from the consistent factor exposures. Having said that, let's have a look in terms of how to use this product in a portfolio. And given what it means, we're going to look at the diversification benefits, if there are any, using the diversification booster. So we see it has a track record of almost 7 years, which is great. Gives us a bit of data to play around with. Has a correlation of negative 0.8 to stocks, slightly positive correlation to bonds, and negative upside betas, downside betas. Negative upside beta means if the market is going up, you lose. That's also good, but expected. But if the market goes down, you make money. And the ratio between those two is quite favorable. What's less favorable is if we stimulate adding a 25% allocation of tail to portfolio comprised of the S&P 500. And what you can see on a standalone basis, the S&P 500 had a Sharpe of 0.67. If we add 25% allocation to tail, it only goes up to 0.7. And this is where it's important to differentiate between a hedging strategy and a diversification strategy. And maybe let's take a diversifying strategy in order to compare both, or contrast both. So you can go to Fund Explorer strategies diversifying. We're only going to look at ETFs. You can actually look at the diversification and hedging scores of all ETFs and mutual funds within this tool. And let's pick BTAL. So BTAL is a diversifying strategy, and let's contrast that with TAIL, again on this diversification booster tool. Now, TAIL is here. BTAL, it's a product, an ETF from AGF. This will load probably, so let's do it again. There we go. Excellent. So here we actually see TAIL versus BTAL. BTAL has a slightly less negative correlation to stocks, slightly lower correlation to bonds, but also upside and downside betas are lower. Now, what we do see, however, if we do the same analysis we've done previously, where we simulate adding a 25% allocation either to TAIL or to BTAL, that effectively the Sharpe ratio, when you combine with equities, is a lot higher with BTAL and with Finominal. And that simply highlights what tail is. And there's one kind of final analysis we do, which is how both of these products would have behaved during the last 3 stock market crashes. And we can see the 2018 market sell-off, we can see the COVID-19 crisis, and the 2022 market sell-off. Now, these events were slightly different in a sense that in 2018 and during the COVID crisis, stock markets crashed rather than having a bear market. And here you see the difference between a tail risk strategy, as represented by tail, which performed quite nicely, 14–15%. Market was down in both cases, versus BTAL was somewhere between. And the bear market, where effectively BTAL performed quite nicely, market was down, and tail was down. And that kind of concludes our product review. And we're going to leave it with tail being a little bit like a Swiss knife. So it has a very precise way of being used in a portfolio, and that is only if someone expects a stock market crash, which should be very challenging. But if you do have that perspective, then tail is a strategy for you. If you are more looking for a diversifying strategy, there's plenty of other ones that you can probably implement more on a structured basis portfolio than on a one-off basis. That's it today. Thanks for that. Have a nice day.